Welcome to Option Trades Today. I'm Tony the Baptiste, and I've got a trade idea for you today. September 12th, 2023. But first, let's look what the market's doing. Even the S&Ps are down 24 handles right now, trading near their lows. NASDAQ is down 150, trading near their lows. Russell's down 260, and the Dow is down 50. Volatility is anemic, not going anywhere, up 10 cents only, trading near its lows, 14.75 presently, a new low made today at 14.45 earlier today. When you take a look at what's going on, since volatility is so cheap, you can see IV rank, nothing when I go here from high to low. When I look at this, you'll see there's very few stocks that we trade that are, over $30, $40, $50. I already have an Adobe position. FedEx would be the next one, but it has earnings. I like to avoid earnings. There's no stocks, but one creeps up here. Look at Oracle. Oracle post earnings down $15. And although the IVX 5-day change is down 9%, the IV rank is still relatively high at 30. That IV rank at 30 is high relative to after earnings. It had earnings last night, and usually we will see after an earnings play that this IV rank goes to zero. So volatility is definitely staying up in Oracle. Usually you'd see it back down here around 2 or 3%. So I'm going to put on a post-earnings trade in Oracle. Now, I have to think to myself, October is where I normally go closest to 45 days. October 20th, with 38 days to go, would fit that bill. Am I looking to kind of catch a falling knife here? Maybe Oracle has been one of the most stellar stocks in this most recent run up, or am I going to go a little bit more delta neutral? I looked at both scenarios. The problem I see in Oracle from a trading standpoint are these $5 wide strikes. Well, I wanted to do a 1-by-2 ratio spread. I actually wanted to stagger the strikes, but look what happens. I'm doing it for a debit. So I'm forced to do a 1-by-2 relatively tight $5 wide, which was within my parameters for a $100 and change stock. But look at this. I'm doing it for a debit also. So that doesn't fit my bill. So then I decided to take a look at maybe just a plain old strangle in here. I went with the 20-ish delta, which is right around the 105, and the 20-ish delta call, which is right around the 120. And look what happens, $2.31, only $1,500 in buying power, fits my bill, but that $2.30 seems a little bit low to me. So the two strategies that I wanted to do in October don't fit. So I have to move out, and I have to move out to November with 66 days. You'll notice the first thing I'm going to look at is the volatility between the two. OC and no volatility are basically exactly the same, 27.2 to 27.6. If no volatility was significantly lower than October volatility, I would not look to put on this trade. I then went to look at that same 1-by-2 put ratio spread that I wanted to put on. And again, it looks like it's a small debit, so not the type of trade I want to put on. So I went by the 1-by-2, a normal one. And here you're going to be able to catch a little bit of a credit, 44 cents, still not enough. I want to be around the $1.50-ish range if I can on a 1-by-2 ratio spread. So that brought me back to my plain old strangle, 105, 120, that I got filled at $4.03. I did the 105 in November. I did the 120 in November, 66 days to go. It brings me right to around that sweet spot that I like of a 65 or higher pop. It gives me a theta decay of almost $6. My delta is negative by 173. I call that delta neutral on the $1,500 in buying power, $1,554 in buying power that I'm using. I certainly could have widened it out and got that same kind of credit that we were looking at on the shorter dated October options, but I was able to move it $5 out. That's for the same, almost the same credit. That's very typical of pricing. Usually 1 month to the next, you can go out another strike, meaning a further strike out of the money, give you a higher probability of success for that same credit that you got in October for the strikes that are one strike closer. I'm going to go with the 20-ish delta. Maybe it's leaning a little bit short by 1.39 deltas. I don't really consider it that short. I'm looking for that volatility that we talked about in the beginning of this podcast to come in after earnings and a big earnings move here. I feel it's going to take a couple of days to happen, but I'm willing to wait. But one thing you can't wait is to bring your account to Tasty Trade. Do it immediately, if not sooner. Bring your account to Tasty Trade. Take advantage of some of the great perks that we have there so I can keep the lights on here.